Welcome to Investor's Guide. This is the show that helps you find the investment that you need that will make you rich over the long term. It's a very important show right now that we're going to do this week, so you should pick up a pen and paper and write down the advice that you hear on the show, especially if you have a young person who's just begun working in your home. Write down the advice on their behalf. Also, at the bottom of your screen is our email ID, so if you'd like to get in touch and ask us a question, that's a good way to do it. On the show this week, we'll tell you why you should not be investing in thematic funds. In our product review, we look at the DSP BlackRock Top 100 equity, and we'll also help you find the right health insurance cover. Let me first bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show.
Thank you.
We were just looking at the numbers of various mutual funds and the performance over the last couple of months. If we look at the last 3 months, here's the interesting thing. Pharma funds, which were gaining so much attention over the last 1 year because of their good performance, have started to slip. So if we look at pharma funds over the long term, it's a pretty good return, 27% annualized over 3 years, 20% annualized over 5 years. But in the last 3 months, pharma funds have been the worst performers. They've lost 10%. Does this sort of reaffirm your conviction that we should not be using thematic funds at all?
The primary reason why investors should not invest in a pharma fund is that the only thing investors have a control on is a basic principle that they should diversify. They should choose a good fund manager. The fund manager in turn should diversify. And individual investors should manage their risk or mitigate their risk of, or reduce the possibility of catching a market high by not concentrating and spreading their investments over time, not invest at one go. So it is violation of the core principle of investment for an individual investor. These are the only things which come in handy when you are investing in equity. Everything else fails. You can't predict the best sector which will do well. You can't predict the best, you can't perfect your timing of making your investment. So, it's very difficult to, find the great sector or the great company. So one must diversify. And I think these should be non-negotiable principles for any investor.
All right. So here's the thing that we've been telling you for a while now. If you're going to invest in pharma funds or in banking funds or in thematic funds like infrastructure funds, you must realize that all of these sectors are cyclical. They will do well for a few months and then they will do badly for a few months. And so then if that's the kind of investment you want, you should be prepared for that kind of volatility. Alternatively, the wisest and the smartest thing for an average investor to do is to pick a fund that invests across the market without forcing it into a box of one particular sector. So what Dhirendra is saying is basically avoid all thematic funds and invest in equity diversified funds. On your screen right now are the equity diversified funds that we recommend on this show. Also, before we move on to answering questions, I'm also going to pop up on the screen the equity-linked saving schemes. These are tax-saving mutual funds. They're on your screen right now. It is the first week of April, so it's a quick reminder for you to start doing your tax saving now and not to wait till the end of the year when we have to scold you and you have to do it in a hurry. Start doing it right now. It's on your screen. If you send us an email, our team will email this entire list to you as well. Dhirendra, let's move on to our portfolio question. 28-year-old Vineet Agarwal has written in. He tells us he's divided his goals into short, medium and long term, and he's told us what his targets are. He wants to save enough for his own wedding and to buy a home in the next 2 years. He wants to save for his child's education, his child's wedding and his own retirement. Now remember, he's not married yet. He's putting aside money for his child's education and his child's wedding and at a later stage for his own retirement. So this is what his goals are like. Between 2 and 5 lakh rupees in the short term, 30 lakh to 60 lakh rupees medium term and about 2 crore rupees long term, Dhirendra. He has a health cover given to him by his employer. Vineet, I would like you to buy a separate health insurance cover for yourself and for your family when you do get married. He's investing 35,000 rupees in the PPF, 44,000 rupees in the LIC Jeevan Anand, and he's planning to take a term cover after he gets married. Before we get into his SIPs, Dhirendra, Jeevan Anand and PPF, they don't suit his long-term goals and they don't suit his short-term goals. Should he just exit both of those investments, at least to the extent that he can at this point?
No, it is great to find, Vineet, that he's planning it so nicely. And planning at this stage is very helpful because something which works in investment unfailingly is time. If you give investments, if your investments are invested for a long period of time, they almost always work. Don't make faulty investments. have your emergency fund, get your health insurance, get a life insurance, enlarge your life insurance when you get married, increase your life insurance when you have your child, and invest all the money in equity, all the residual savings, and the money and to the extent you can save taxes, that money should find its way into tax saving fund every year. Money beyond that, beyond 1.5 lakh rupee, should find its way into general equity fund, and always be regular with your investments. And if you are methodical with this, if you are if you are doing it with discipline, you will be able to realize all your goals.
Right, so it's very simple advice. There is a fault also in overthinking things, but we're very proud of you for having thought through your finances so carefully and planned so far ahead in your life. So at any point when you start investing, it will always hold you in good stead in the future. Let's take a look at his SIPs. Now, he's altogether investing about 8,500 rupees a month in his SIPs. The Canara Robeco Emerging Equities is one. The ICICI Prudential Value Discovery, JP Morgan India Small and Mid, the SBI Magnum Mid Cap Fund, and he's also got Tax Shield. So Franklin India Tax Shield, IDFC Tax Saver, the Reliance Tax Saver, SBI Magnum Tax Gain, and of course the Axis Long Term. Would you say, for my comfort, there are one too many funds in his portfolio. It might make some sense to sort of streamline them, but they're all good funds. What would you recommend he does with this portfolio?
He can do a very simple thing here. As he has 5 tax saving funds, he can discontinue investing in 3 and build his, accumulate his savings in 2 of the 5. That will reduce his number of funds to just about 6. And when the other 3 funds, when they are out of the lock-in, he should consider reallocating that money in the other funds. Yes, his general equity funds are, fairly aggressive. And if he is fine with the ups and downs, this should translate into substantially higher return over a long period of time. These funds are particularly suited for somebody who is investing in the bad phase of the market as well, and that actually translates into superior return for him, because investing in such funds in a not so good market phase is extremely difficult. You see the prices crumbling and you still continue investing. And when they go up, so that if he's fine with it, as he has done over the last 2-3 years, he should continue doing it.
Well, that's the advice you're getting right now. And remember, if you'd like us to take a look at your portfolio, email ID is at the bottom of your screen. We're going to take a quick break. Virendra will stay with us, though. We'll come back and talk about the DSP BlackRock Top 100 Equity Fund. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for our product review. This week, we're looking at the DSP BlackRock Top 100 Equity Fund. Avan is here to give us a quick introduction. Avan.
Thanks, Faye. This week, we take a look at the DSP BlackRock Top 100 Equity Fund. This fund has beaten its benchmark and its category average over the long term. But the exit of its fund manager in the year 2015 has placed the fund under review. Let's take a look at its performance in the recent times. A quick look at the fund's performance over the last 5 years shows that the red line, which is the fund, has performed slightly better than its benchmark, which means it's an average performer and not the best in its class. In the year 2013, the fund underperformed its benchmark and category, giving a return of just 2%. Despite picking up the following year, in the last 1 year, the fund's performance has slipped again in the performance chart. The fund's rating also slid in the last 1 year post the exit of its fund manager. The fund may have performed better than its category over the long term, but still does not manage to stack up quite as well when compared to its peers, with better performing funds in the same category. So does this mean that it's time to exit the fund or continue holding on to it? Let's find out, but that's back to you, Faye.
All right, Avan, thank you for those numbers. They're currently 3 stars on value research. The assets under management have dropped a bit as well. Performance over the last 1 year has not been great. Would you recommend we continue to hold on to these funds for the last, for the 2,900 crore rupees that's still in this fund? Would you recommend they hold on to it?
No, it's a fairly mediocre fund, and it's not a disappointing fund. It's not a great fund either. This is a large cap fund. It is supposed to invest in top 100 companies on BSE and NSE. and it beats its benchmark. BSE 100 is its benchmark. It beats its benchmark over, in last 10 years, it has beaten its benchmark every year by a very modest margin. And it is anchored around the average of the large cap funds, the return on an annual basis as well as most trailing time period, 1 year, 3 year, 5 year, 10 year. So it beats the benchmark. It is around the average of a large cap category. Investors have reason to be disappointed with this fund because last 3, 4 years, 5 years, large caps are not the big drive. They haven't generated substantial return. Markets have struggled, and the happening segment of the market was not in the large companies. So that is why investors are disappointed.
And actually, Dhirendra, I'm going to ask you that now. Beating the benchmark is normally considered good, but is it enough? So, I mean, obviously there are investors of this fund who are going to be interested, but investors of any fund who are looking at it saying, okay, it beats its benchmark. It's still around the average performance in terms of other, comparisons to the rest of the category. Is beating the benchmark enough?
No, not really, because if we look at the Indian, beating the benchmark over a long period of time should be enough. And but by a very nominal margin, I find that the kind of price we pay, and if we are able to beat the benchmark by a very nominal margin, it just might not be worthwhile. I expect that one should be right with a big sector or a stock bet, and few of them should actually work out substantially for the fund, which has not materialized over the long period over a period of time. Yes, the fund has avoided any big mistake, which is what is providing it the comfort of being beating the benchmark and being an average fund or a little above average fund.
All right, Dhirendra, finally, what's your rating of the DSP BlackRock Top 100 Equity Fund?
I will slot it just as its risk-adjusted scale, on its risk-adjusted scale, which is 3-star.
All right, 3 stars there for the fund on Investors Guide. Dhirendra is saying that it beats the benchmark, which might be okay, but you can do better if you're an investor. So there are better options for you in the market. This is the show to find those options as well. Let's move on to our hold or sell segment. 29-year-old Deepak has written in. He tells us he makes about 57,000 rupees every month. He has a term cover, he has a health insurance cover, and he says about 10% of his salary goes into the NPS. He's been investing 10,000 rupees every month in mutual funds, and he sent us a list of the funds that he's investing in. I'm going to assume, Dhirendra, that these are long-term investments because they look like long-term investments to me. First on his list is the DSP BlackRock Micro Cap Fund. Continue that investment?
Yes, but it depends. It should be a small part of his investment. It should not be exceeding 20%. This is a fund which has done exceedingly well in the last 1.5 years. And this is a fund which can actually be very disappointing. In a bad market, this fund will do very poorly. So it requires, many people look at recent performance and invest in a fund. And they haven't seen how this fund can, how disappointing this fund can be. And if one can stick through one's investment plan in those periods, such a fund can be very rewarding.
But Dhirendra, he is investing equal portions in all of these funds. So 2,000 rupees in each fund, and that's a total of 10,000 rupees in 5 funds. He has a Franklin India High Growth Companies, which is the next on his list. And it does seem like his entire selection is all mostly mid-cap. So would you recommend he continues this one as well?
Yes, it has been a good fund. But as I said, it may not be as disappointing as a micro-cap fund on different occasions. But this fund can also be very disappointing when you bet on growth and growth doesn't come by, doesn't come by for those companies. Those companies show great volatility. They can actually fall much more sharply. So one has to be prepared for great ups and downs even with this fund.
All right. There's also the ICICI Prudential Value Discovery Fund, Dhirendra, and HDFC Mid-Cap Opportunities. Continue both of these investments as well?
Yes, these will actually provide his overall portfolio greater stability. And Value Discovery is the exact opposite of High Growth Companies Fund. Likewise, the Mid-Cap Opportunity Fund is relatively stable, larger mid-caps given its size and its orientation. So despite being a mid-cap fund, it's not going to be, it's not going to show the extreme volatile character of a mid-cap fund. So yes, these two funds will provide him greater stability.
Last fund of the list is the Reliance Equity Opportunities Fund. Continue this one as well, Dhirendra.
Yes, this is a good fund of the lot of the Reliance family, and if we are in for good times for the market, this fund should start delivering great performance once again.
All right, so that's the advice you're getting. It's on your screen right now. If you'd like us to take a look at your portfolio, feel free to get in touch. Our email ID is at the bottom of your screen. Dhirendra, we've run out of time. Thank you so much for joining us. It's been a pleasure to chat with you. If you'd like Dhirendra to answer your questions, email ID is at the bottom of your screen. When we come back, we'll talk about health insurance. Don't go anywhere. Welcome back. You're watching Investors Guide. Thank you for staying with us. This week, we're going to answer your questions on insurance. Gajendra Kothari joins us right now. Our first question comes in from Richard Lobo. He says he bought a life insurance policy from Max Life with a monthly pension. Now, he bought this policy this year in February, and the policy requires him to pay a premium of 2 lakh rupees per year for the next 2 years. And from the 13th year onwards, it will give him a guaranteed return of 24,000 rupees a month for the next 10 years. He wants to now know if he should return that policy or not. Well, he's out of that free look period that you get for 15 days after you buy a policy. What would you recommend he does?
So if you actually analyze this policy, this is a traditional pension plan, wherein your money is invested mostly in debt instruments. So this policy in altogether is around 22 years long. So for such a long period to invest in a debt product wherein you fetch around 7 to 8% return per annum is not a very good idea. Because you have time on your side, you should be ideally investing into products which invest into equities, because as equities can give you long-term returns. Although you bought the policy, you still have some free lookup period, which is basically 1 month or 15 days depending on policy. So I would rather recommend you to surrender this policy right away, so that you get back your premium and you're not stuck up, because the moment you cross the free lookup period, then you're stuck there. Then you can't do anything much, and you'll have to stay for whatever the minimum time frame, and you'll lose a lot of money when you're surrendering. So my return is return this policy, because in the long term you cannot expect more than 5 to 6% return from this kind of a policy. The problem is that most of these policies are missold to customers by the word guaranteed returns, and most of these the agents who sell these policies, they give you a month absolute figures rather than what percentage you are earning on your product. So I would recommend that. And secondly, don't mix insurance and investments. For insurance, only go for term insurance, and for investments there are various products like fixed deposits, PPF, or mutual funds. Depending on your risk profile, you'll be far better than buying this kind of a combo plan.
Next question comes in from Shaibal Ray, who tells us he unintentionally invested 50,000 rupees a year in a 10-year ULIP last year. He wants to know how much he'll lose if he surrenders the policy before the 5-year lock-in period is over, and what the tax implications will be. Unintentionally investing in an insurance policy can be a very expensive prospect, Gajendra, because the first 1 year, those charges are very, very high. What is the likelihood that he'll get some of his money back at least? You have not mentioned which policy you bought from which insurance company and what was the product name, so it's a bit difficult to to give comments on a generic policy. Still, we'll try our best to help you solve the query. See, in a ULIP product, normally in the newer ULIPs which came post 2011, now there is a compulsory 5-year lock-in period. So you cannot withdraw this money before this period, and of course the surrender charges have come down quite a bit compared to the previous ULIPs. So let's say you have just paid 1 year premium, and now you decide not to pay future premiums and you want to surrender this policy. First thing, you will not receive this money before 5-year period. Your money will go into a discontinuance fund, and there the money will be earning just the rate as in savings bank account return of 4%. So that's the first thing. Secondly, with regard to the surrender charges, so if you're surrendering now in the first year, most likely most companies have this 6% of the surrender charges of your premium amount, or 6,000 rupees, whichever is higher, whichever is lower. So that would be deducted, and if you taper off, so if you surrender next year, then it will be 5%, come down to 4%, 3%, and so on and so forth, and at the end of the 5 years it will be nil. So if you think that the policy is not good and the charges are high, you can surrender it, and of course you'll lose 5 to 6%, but still it's better than paying future premiums.
And secondly is that with regard to the tax query, you will have to pay no tax at the end of 5 years once you receive the money. So that will be entirely tax-free in your hands.
Last question comes in from Aniruddhan, who writes in saying he wants to buy health insurance for his parents. His father is 63 years old. His mother is 54 years old. He wants to buy a floater plan for both of them and a senior citizens plan for his father. What should he do?
With regard to the health insurance query for your parents, of course, we need few more data. You mentioned that your parents do not have health insurance right now. First thing we need to find out that do they have any kind of pre-existing illnesses, because that's a major deterrent in buying a new policy. If your parents have any of these kind of pre-existing illness like diabetes, hypertension, blood pressure, cardiac, or so then the company may exclude these in the first 3 to 4 years, and or some companies may even reject the proposal. So we need to be very careful. We need to be absolutely honest in providing all this information so that later we don't have any issues. Once assuming that both are healthy and absolutely they're not taking any kind of medicines, then I would strongly recommend to go for these for health insurance covers as soon as possible. You have two options. One, you can take individual health insurance policies for each of your parents. So normally I would recommend that, because now since they're getting older, the likelihood of each going to hospital would be far more frequent than compared to a younger person. So in case of individual policy, that policy can be utilized to a right extent. So, or if you want to save some cost, you can take a joint cover, of course with a little higher amount. You will save some money compared to individual policies, but then the risk may be there that if both of them were to be hospitalized in the same year, you may fall short of the amount. Just to give you an idea of a floater policy cover for a 5 lakh sum assured for both the parents at the age which you mentioned, the approximate premium would be around 30 to 35,000 rupees. Now, almost all insurance companies have health insurance policies. You can go for any of them depending on your preference. A few things which you should be knowing that whether there are so in which area you live, which city you live, what kind of hospital rooms charges are there, and the procedure cost. Depending on that, you can go for the policy. The only thing you need to be checking in these policies is the terms and conditions, like is there any capping on the room rent, or any capping on other procedures like cataract surgery or any kind of special routine surgeries. Also, you need to check majorly is there any kind of co-payment applicable. Co-payment is something wherein you need to share 10%, 20% or 30% of the total cost of the procedure, and the rest is paid by the insurance company. When you go for co-payment, of course your premiums are cheaper, but then any such instances happen, then you may need to shell out this kind of amount. So you need to be sure whether you want to go for co-payment or without co-payment. All these terms and conditions you have to look in, and then you can kind of choose a plan which suits your budget.
All right, that's a wrap on the show. Thank you for watching Investor's Guide this week. Gajendra, thank you for answering those questions. Our email ID is at the bottom of your screen, so if you would like to ask us anything to do with your money, feel free to get in touch. Tune in next week to catch Investor's Guide. Thanks for watching.